So what I'm proposing very simply then is a 15% made in America corporate tax rate, cutting it from 21% all the way down to 15%, but only for those who make their product in the USA. It's very simple. Manufacturers will also be rewarded with expanded research and development tax credits, very substantial, where they will be able to write off 100% of their cost of heavy machinery and other equipment necessary to build a plant. In the first year.
Former President Donald Trump just moments ago at the Detroit Economic Club making many promises, among them what you just heard, to bring back a tax break he actually had inherited from presidents going back to 1958, but had reversed as part of the GOP's 2017 Tax Cuts and Jobs Act. Trump is working to appeal to Michigan's massive automotive workforce by revealing a slew of tax policies, including the 15% Made in America corporate tax rate, tax credits for heavy machinery, and also a plan to make interest on car loans tax deductible. But no matter who gets to be president, whether it is Trump or Kamala Harris, whoever gets to be in the White House again, how will the overall market and economy perform? Joining us now in a Fox Business exclusive, Guggenheim Partners Investment Management CIO Ann Walsh. Guggenheim manages $320 billion in assets. Thank you for being here.
Thank you, Liz.
Well, it's sort of the season where there are a lot of promises being made, but let's tackle what Donald Trump just mentioned. And he rolled out a bunch of different things. And among them, these tariffs that he talked about, that you didn't hear, but he said that he would slap 100% tariffs on China if China were to buy one single barrel of oil from Iran. I mean, you got to tell me exactly where you think some of these things would be even possible and how they would help the economy.
Well, let's think about where we are in the economy right now. And your prior guests were also speaking about something we have had as a theme for the last 18 months, and that's the bifurcation in the economy. We've seen the bottom 50% of income earners really lag behind relative to the top 50% or the wealth class, if you prefer. And I think that's part of President Trump's thought processes, is to try and create more targeted tax policies or programs, for example, like the interest deduction for car loans, no taxes on Social Security, and the like, trying to maybe address some of this dislocation that's been going on in the economy and this bifurcation. The question is, I think he needs Congress to do it. As is mentioned, for example, the capital expense tax deduction that we was just mentioning, that was not part of the 2017 tax program. I think whatever happens, 2025 is going to be probably one of the most significant potential tax repositioning years that we've ever seen. There's so many expiring tax programs, and then there could be, assuming Trump becomes president, there could be a whole new set of tax programs or incentives for America First processes and policies that it's quite clear he supports. And so we could see a huge dynamic. If Harris wins, we could see a complete change and shift in tax policy in the other direction.
Let's talk about corporate tax rates. Donald Trump had moved it from the very high 30, 35, 38% in the United States. And we saw a lot of companies leaving because it was just so onerous for them to do business. And he brought it down to 25%. Now he says 15%, but only for companies who make their products in America. I mean, there were a lot of fine print pieces there because maybe they're assembling it in America, but pieces of it came from Asia. We don't know. But at what point does anyone, either candidate, tackle the deficit and the huge debt, which in the end is really possibly the biggest problem for not just the lower middle class or the wealthy, but everybody?
Right. Well, if we take the deficit spending, which we've been deficit spending to the tune of close to $2 trillion, even if it goes down a little bit, it's not going to really move the needle that much. And so I think that from a bond manager's perspective, we talk about the bond vigilantes, but they've been, for the most part, absent during this process. That's likely to change as a result of the fact that interest costs have gone up so much for the U.S. government. At this point in time, we're looking at interest costs being about the same as the defense budget. And
that's crazy.
That's extreme.
And everybody's talking about cutting taxes. Where's the cutting spending?
Right. And I think that has to go hand in hand. Otherwise, what we're going to just see is just explosive costs to the fiscal budget. And of course, the cost ultimately to the taxpayers.
You and I aren't running. Okay, unfortunately, you're not running because something tells me you would have some things that would whip this problem into shape. But that said, you know how to invest through it and around it. Where on the bond yield curve would you be investing, knowing that it may take a long time before we can tackle these issues?
Well, and I think we are in a trajectory towards continued lower rates, and we are in a trajectory towards lower inflation. The Fed has, notwithstanding fiscal spending, been actually able to engineer this slowing down of the economy to get rates down. What we're in a trading range, though. It's a kind of a boring, time in bond markets, even though we're in a very volatile period of time. What we're doing is we're seeing a range between 3.5 to say 4.25 now on the 10-year, and so we're going to just oscillate in that space for quite some time.
What, 10, 7, 5?
Yeah. So mostly, the 10-year in terms of where we'd want to be on the curve, in the belly of the curve, 5s, 7s.
Okay, so not short term. There's the 10-year, 4.092%.
Yeah, and we're at the sort of the top of the trading range. So if we think the peak is probably 4.25 on the 10-year trading range, we don't have a lot more to be oversold at this point in time. Now, the other end, the short end, we have some volatility. We have an election coming up in a very short window of time, and investors can feel pretty safe sitting there at the short end in the short term while we get past this volatility.
Okay, now let's say we get past it. Let's say, for purposes right now, Donald Trump gets back in the White House. Which equity sectors do you think would benefit the most?
Well, I think in this particular case, with costs going down, interest costs and so forth, that tends to benefit the more interest-sensitive parts of the economy, but at a slower rate. Large caps are still a really good place to be. And I think that investors can feel pretty good about dividend clipping and the benefits of being in large cap stocks as well.
Everybody thinks, energy would do well. But interestingly, fossil fuel energy did really well under Biden, not so well under Trump. And then just as oddly, green energy did better under Donald Trump than it did through Biden. So if Kamala Harris were president, could you make a guess as to which sectors might benefit?
That's really interesting. I think that if Harris were president, those green spending programs will accelerate, and I think those stocks should actually do pretty well. Oddly enough, notwithstanding the fact that they did well in prior administration.
So we got today's CPI number out, slightly hotter than expected, which means that prices are still up. But by the same token, we have also seen some strength in different metrics of the economy. How do you see the U.S. economy right now? And ahead of this election, when we hear it's horrible or it's amazing, the truth, I'm sure, would lie somewhere in between.
Well, I think, again, we'll go back to the bifurcation. Those companies that are issuing stocks in the stock market have access to capital. They're doing pretty well. And that's where we put our dollars for the most part. And the third of the economy that's interest sensitive, small businesses, they're not really in the market. They're not market issuers. And so as a result, they're the part that's struggling. For the rest, they've delevered coming into this cycle. Their fundamentals are very strong. Their interest costs are down. And their leverage levels are down. So we're looking at issuers that have a great deal of fundamental quality behind them. And as a result, investment-grade corporate bonds, investment-grade bonds, even high-quality, high-yield bonds are doing well. Large-cap companies, those with access to capital and solid business models, margins have been high. This is a good story for fundamental corporate America.
So does corporate America need another tax cut when it comes to their rate?
Well, they won't turn it down, and
of course not.
But
you're saying they survived just fine under 15%?
Yes, they absolutely will survive at where we are. The concern for investors would be if Harris were to win and capital gains tax rates go up. Then we could see a very significant impact to the markets as investors reposition and or sell, take those capital gains while they have the chance.
She did say that would be for people with $100 million or more, but we just don't know. That's the point. As we finish up, there are so many scare tactics on both sides of what will happen if this side gets in, that side gets in. What's your gut feeling, Ann?
Well, I think we have a bright future. You know, I'm very much a America supporter, a patriot, and I believe that the future of America is always bright, and the opportunity is always there to harness, you know, the American enthusiasm. So I think we're in a good place still.
Great to have you. Thank you so much.